Well, good afternoon, ladies and gentlemen. Happy Friday, March 6, 2015 to you all. It's great to see you all here for our Power Options Radioactive Trading Open Forum Q&A session. I hope you are all doing well, of course, and I hope you have all had a good trading month so far. Saw a recent pullback the past few days in the market. Some of you may have even had expirations come up today, of course, if you've been trading the weekly options, when we have expiration coming up in about 2 weeks for the standard March expiration, of course, series that expire on March 13th and beyond as well. Well, before we begin today's presentation, we always just want to briefly introduce who we are. What, of course, is Power Options. Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance in a given strategy, and we do support tools for over 23 of the most commonly used option strategies. Once you've identified those positions, either through the search or just through one of our search by symbol tools in a given strategy, you can then quickly compare the risk versus reward, run deeper research and analysis into the underlying stock or the options as well, compare other strike prices and other returns and probabilities, and evaluate which position best suits your investing needs. In addition to that, we do offer a powerful set of portfolio tools to help you track, manage, and adjust your option positions, regardless of which strategy you're trading, whether you're doing spreads or four-leg spreads, such as iron condors, for example, or iron butterflies, calendar spreads, covered calls, naked puts, and so forth. We do offer also countless educational articles, help pages, help videos, and archived webinars to help investors get more familiar not only with the tools on the site, but the various option strategies that are supported on Power Options as well. Now, Ernie Zerenter created the Power Options tools over 17 years ago. Everyone here on staff uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. And for those of you that don't know me, my name is Mike Chupka. I am the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerenter and their Power Options staff for the past 12 years or so. I do handle a lot of the coaching sessions, so those of you that are currently on a trial, or if you're a subscriber to Power Options, you can schedule one of those sessions at any time. It's essentially a 35 to 45-minute phone conversation where myself or Ernie will walk you through the tools on the site and answer any questions that you have. Now, I am versed in all of the strategies we support on Power Options, plus many others. However, there are certain strategies I've never traded in my personal account, things such as naked calls, short straddles, short strangles, or iron butterflies. Those positions just don't match my personal risk-reward tolerance. However, if you do have questions about those today, we'll be more than happy to answer those for you and show you some of the tools that you would use to implement those strategies using Power Options. Now, our process and procedure for this afternoon's presentation, when you logged on to the webinar, the GoToMeeting, GoToWebinar platform appeared on your screen. Inside of that platform is a question pod. So just use the question to pose a question to us at any time during the webinar. Please feel free to ask as many questions as you want. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. However, if we do have a high volume of questions, I'll be more than happy to stay on until maybe 5:45 or 6 o'clock or so to make sure that all questions are answered. Your questions can really be about anything. If you have general questions about option strategy, such as what would I look for in a covered call trade? What should I analyze when looking at a bear call or a bull put spread? What kind of positions would one look for during a calendar spread? Is volatility or the Greeks important when looking at a bear call spread or a naked put, for example? If you have specific questions about using the tools on Power Options, the search tools for a given strategy or the portfolio tools for your trade management, that's all free game as well. If you have questions about the concepts of the radioactive trading techniques, which we're kind of partnered up with Kurt Frankenberg there, and I trade the radioactive techniques in my personal account as well, please feel free to send those over also. Our basic ground rules, of course, don't be shy. You know, this presentation is designed for you to have an open and free forum to have your questions answered, so please feel free to send us those questions at any time. Be patient. There might be one or two questions ahead of yours. However, we will get through them all, as we mentioned before. We also want to encourage you to feel free to help us help others. So if a question comes through from one of our attendees, and I give an answer based on my market experience and what I've done in the past and how I've managed positions as well. And you feel that maybe I glossed over something and there's a different adjustment that an investor should consider or should evaluate, use the question pod to send that to us, and we'll share that with the audience as well. Most important, let's have some fun. Let's get some good education under our belt, and get ready for the weekend and get ready for our next trading week as well. All that being said, I'm going to navigate over to the PowerOptions suite of tools at this time. Oh, sorry, there we go. Let's see here, and we're going to start off with a couple of our questions that have come in. The first question that came in is from Bill, and Bill wants to know, can you discuss how to analyze the risk of a particular bull put credit spread? Well, particular bull put credit spread, if you're looking at a specific spread, Bill, and you want to send us the strike prices and the expiration, sure, we can take a look at that. But if I'm looking to evaluate a bull put credit spread, let's say on a given stock, so let's say I was interested in doing a bull put credit spread on Apple. Okay, instead of looking at the universe of available bull put spreads, I know I want to do it on Apple. I'm neutral to bullish on Apple, let's say, and I want to take a look at a bull put spread. My first step, naturally, is that I go to the bull put credit spread tab. Of course, for those of you that might not be familiar with this strategy, what we're doing here is we are going to sell, in a bull put credit spread, we're going to sell a just out of the money or out of the money put on a given stock. So the stock might be trading here. We're going to sell an out of the money put. At the same time, we're going to buy a deeper out of the money put. This will result in a credit. Our true risk is going to be defined as the difference in the strike prices, the option that I sold and the option that I bought, minus the net credit. We'll receive the full profit as long as the stock stays above our short put strike price. Both puts will expire worthless. We'll keep the net credit. And the maximum loss is realized if the stock falls below our put strike price positions. The margin spread, usually you can see double-digit potential returns in a bull put credit spread. Of course, the risk to reward ratio is usually 9-to-1 or 10-to-1 because of the leverage. Let's take a look why. I'm looking one stock at a time. Under bull put credit spread, I might start with the search by symbol tool. And this is just going to allow me to plug in my stock symbol, so we'll go ahead and plug in Apple. And I can just let's look out to March, the standard expiration that's about 14, 15 days away. And for right now, I'm going to go ahead and look at more results. This just helps us narrow down the filters. I could look at all results, but I know more than half of those trades I probably wouldn't enter based on what I look for in a bull put credit spread. So I'm just going to leave it at more results for right now. Let's go ahead and submit that and see what we get. Okay, now, we see here a basic view. We know that our stock is currently at 126.60. So I know I'm probably going to be looking to sell put options to start our spread that are at least at the 126 level or lower. And that's our first line here. And we see the first spread that comes up, we could sell the March 126 put for $259. So if we did one contract, we'd collect $259. And at the same time, I'll buy a March, maybe, 125 put at $219, excuse me. This will give us a total net credit, the difference between the two options of 40 cents. Now, because this is a 1-point spread, I'm collecting 40 cents. My max risk will be the difference in strike prices minus the net credit. So at expiration, if our stock's trading below 125 in this example, I do have an obligation to buy shares of stock at 126, but at the same time, I've bought the right to sell someone those shares of stock at 125. So I'd have a dollar loss, but we keep the 40 cents regardless, so our max loss is 60 cents if this position moves against us. So it's showing a very high return. However, over the next 14 days, there's only a theoretical probability, a 53.3% theoretical probability that Apple would stay above 126 so that both puts would expire worthless and we'd keep the net credit. Okay, this is a column that I've added into my field by using the Choose Columns button. If it's not already on your bull put credit spread when you're in the search or the search by symbol, go into Choose Columns, select things such as probability, the max risk, the monetary break-even at expiration, and the range out of the money. It's a little bit more helpful to get a gauge. Now, the reason why I point this out, this return looks fantastic. It'd be great if I could put up 60 cents to make 40 cents and get a 66.7% return. But with only a 53% chance of getting that, if half my positions are right and half my positions are wrong, we're going to lose money because we're risking more in the position. Most spread investors will probably start off in this area here and below. What I mean by that is they're looking for a minimum probability of about 70% or maybe around 75% or more to have that better rate of success. But what is the trade-off with going to those higher probabilities? Let's take a look at one of these 74.4% probabilities. There's two listed. The March 122 put only has a bid of 119. If we decided to do a dollar strike difference, I could purchase the 121 put for 98 cents. So now I'm making 21 cents against an investment essentially of 80 cents or 79. Right? So looking at 20 cents by risking 80, a 4-to-1 risk-reward ratio. And we have about a 26%, we have a 26% return in that case, looking to make 21 cents against risking 79. And we do have a 74.4% chance that the stock would stay above 122 and we'd realize that potential return. Now, is that any better than this other spread? I see here we could sell the 122 and buy the 120. The 120 will cost us less. It's only going to cost us 79 cents. So now we're making a higher net credit, but why do we have a lower return if we're getting a higher net credit? Because this is a 2-point spread. My true risk or my margin requirement the broker would require for me to put up this position would be $1.60. So that's a smaller return. I am getting double the credit, but I've more than doubled the margin requirement, so we have a slightly less return here, 40 cents against $1.60. It's still a 25% yield, and we still have the same probability because both are involving selling the 122 strike put. Now, is one better than the other? Well, it depends on two things. Let me navigate over now using the More Information button. So anytime you're in the search or the search by symbol, we use the More Info button here over to the left of each position to analyze the stock chart, maybe look up the company information, take a look at the profit and loss chart, or look at other strike prices as well. Here's the profit and loss chart for our $1 strike of selling the 122 put and buying the 121. Again, we're taking in 21 cents of net credit, and we'd have to put up 79 cents or $79 per contract. So if we did one contract, we're taking in $21 total. And we would put up $79 of our account to have on hold until these puts expire worthless or we close the position as we get closer to expiration. Now, if you did 10 contracts, you'd be taking in $210 total premium, but you'd have to put up $790 to enter the spread or to have on hold in your account with your broker. Now again, we know this is about a 26% return. We realize the full profit if the stock remains above 122 at expiration. Both puts expire worthless. We keep the net credit. And of course, if the stock drops below our purchase strike price, the 121 strike, we'd again be forced to maybe deliver shares of stock at 122, but we have the right to sell those shares of stock at 121. So we take the dollar loss, but we keep the 21-cent net credit, and that gives us the return there, or the max loss, of $79 on the position. Now, is the 1-point spread better than the 2-point spread? Well, that's more of a personal philosophy based on how many contracts we're looking to trade. Let me get to that 122 strike again for a 2-point spread. Let's take a look at that one as well. Same setup, although we're taking in 40 cents now. We have a risk of $1.60, and we have a wider spread here. Okay. Now, is one better than the other? Well, it depends on how much you're looking to invest in your portfolio into one given spread position. If I was only going to put up $1,500 to enter into a trade, well, in this case, we could do 9 contracts of this particular spread, right? Because if we did 10, it'd be $1,600 we'd have to have on hold in our account. We wouldn't be able to do that. But with the 9 contracts, of course, we'd be taking in $360 of total premium. But we'd still have this same 4-to-1 risk-reward ratio. It'd be about $1,420 or $1,320 here on the margin requirement if we were looking to invest $1,500. Going back to our 1-point spread, however, if you were going to invest $1,500 into this transaction, you could roughly put in 20 contracts. And of course, here you take in about $404. If you did 20 contracts, that would put you at about the risk of $1,600. Or no, maybe you could only do 19, but you'd still be up here at about the $400 range. It'd come out to be about even when you look at it mathematically. So which one's better if I'm doing 5 or 10 contracts based on what I'm putting in? Well, it comes down to what is your monetary premium going to be? In this case, we saw that if we did the the 9 contracts or so. What did I say, 9 contracts here? I'm sorry, folks. Yeah, it'd be 9 contracts. My apologies. So if we did 9 contracts with the 40-cent net credit here, the higher net credit, we take in $360 of premium. And now we have to factor in and say, okay, well, I know that if I'm taking in 360 and my commissions are 15, I'm really taking in, or maybe it's 15 for 1 contract, but if you did up to 10 strikes, maybe you're paying $25. So you take $25 off that and you realize you're making a net credit now of $345, of course, against that margin requirement we had of close to about $1,500 or so. And then I'd have to compare that to the other spread, where I could do is maybe 19 contracts. What is my monetary value if I do 19 contracts times the 21 cents? We take in about $399 in that case. But of course now the monetary risk of 79 cents times those 19 contracts, that would put us up at, about 1,500 as well. So we'd be a little bit over 1,500 in that case, about 1,501, 1,502 for that. Now take off the commission cost, which one's the best monetarily and for the risk of your exposure. Instead of deciding that, oh, I'm going to do 5 contracts here and 10 contracts here, it's better to allocate a monetary amount that you're willing to risk. Because remember, the key here with any bull put credit spread, in addition to looking for the one that has the better probability and the spread that has the, gives you the net credit that you want, is to make sure that you're not risking too much of your portfolio in any one spread position, because you can lose 100% of whatever you invested in the position. And the way most investors set up these vertical spread positions is they are usually looking at an 8-to-1 or 10-to-1 risk-reward ratio. So one loss might wipe out 10 previous trades. And it'll happen from time to time. A stock or even an index or an ETF will just go against you quickly and go through both strike prices before you get a chance to manage the position or adjust it. You've reached the full loss. You can still manage or adjust it at that point, but eventually you will take a significant loss on a spread, or a spread that's close to 100% loss, and you know that'll wipe out maybe 5 to 8 to 10 previous successful trades. Okay, the leverage works both ways. It's great to look at this and say, well, I'm kind of taking advantage of a naked put position by generating a decent premium for selling this 122 put, but instead of putting up the full margin requirement or the cash for doing a cash secured put, we're buying this other put here to give us a better credit. Now, every investor has their own way of approach, Bill, and what I mean by that is that some investors will look for the better net credit. I can get a better net credit on this spread if I bought maybe the 118 put. Further out of the money, it would cost me less. I'm getting a better monetary value, but now I'm going to have more of a monetary requirement. Okay, so if I did the 122 and the 118, that's now a 4-point spread, so one contract would be $4 at risk or $400 margin requirement minus the net credit. Okay, and once again, looking here, what we're not seeing, Bill asked a follow-up question. Could you explain the risk if it goes through both strike prices again? Yeah, this is the profit and loss of bull put credit spread. We're not seeing here is the continuation. When it hits the long put, you have a max loss. You know what that is up front. It's the difference in the strike prices minus your net credit. So for this is a 40-cent net credit spread. For one contract, we'd make $40 net credit to risk 160, 4-to-1 risk-reward ratio. Just because I've entered a spread, anytime you're doing a vertical spread, a leverage spread, or an iron condor, what I want you all to keep in mind if you're following these kind of strategies is to remember that when you enter a credit spread, it does not change the rights in the obligations that you'd have if you just sold a put, a naked put or a cash secured put, or you bought a long put. And the obligations and rights you have here is when I sell this 122 put, even as part of a spread, I am obligated to potentially be forced to buy shares of stock at 120. That is a potential outcome of this bull put credit spread. I may end up owning shares at the short put strike price. In this case, it's 122. Now, I bought a 120 put to protect me against large losses if the stock gaps down to 115, 112, $2 per share. I bought the 120 put, which gives me the right to force someone to buy my shares of stock at 120. All right, so in this case, I can sell stock at 120. That's the right that I have. That's supposed to be an @ sign, but you see what I mean. Okay, so I can sell at 120. Now, stock's at 126.60. We enter this bull put credit spread. If the stock ends up trading at, say, $121.50 or at $121 or $120.50 at expiration, we hold it all the way to March expiration, and the stock, let's say, is trading right at 121 here, right about this price here, my long put expires worthless. It's out of the money. It gives me no value. If my stock's trading at 121, I still have this obligation to buy 100 shares of stock of Apple at 122. Okay, that still has happened. If I did nothing at expiration, if it didn't buy to close my put option before expiration because it's gone below that put strike price, and I left it through Friday expiration, when I wake up Monday morning, I'm going to own 100 shares of Apple at a cost basis of 122 minus the 40 cents we took in, so we'd be at 121.60 would be our cost basis for those 100 shares. The put here, the long put we bought didn't help us because it still expired worthless. Okay, so we would be assigned and be forced to buy shares of stock at 122 if we did not close this put before expiration. And sorry, this just answered Daryl's question. If it expires between the strikes, will I be assigned at the short put price? Yes, if you don't close it before expiration. And remember, at any time between now and March 20th, if the stock suddenly fell to 121 from 125, remember, you can be exercised any time. All right, you can be assigned early. It doesn't always happen, but you could be assigned early, and 5 to 6 days before expiration, you could be forced to buy shares of stock at 122. Now, if you don't have the margin to cover that, then your broker would probably let you know that, or they might turn around and sell the stock immediately at 121 as soon as you take delivery, so that you're out of position for a dollar loss, but you still keep that 40-cent net credit. Now, Bill, going back to the part one, we have an obligation here to buy shares of stock at 122. We've bought the right to force someone to buy our shares of stock so we can force it at 120. So if the stock ends up trading at 118, let's say, it just suddenly drops through both strike prices, or even if it goes down to 100, or even if it goes all the way down to $1 per share, and I do nothing, I don't close the spread before expiration, as we go through Saturday at expiration, these options would be cleared out. Essentially what it would look like, in some brokerages, other brokerages handle this differently, what it would look like is that on Saturday you bought shares of Apple, 100 shares of Apple at 122, you immediately sold them at 120, so you took a $2 loss on the position. But this 40 cents is deposited immediately in your account. You keep that regardless of what happens, so we have that to hedge this full loss. So even if the stock was trading at $1 per share, you'd lose $1.60. All right, so for one contract, it'd be $160. 10 contracts, it'd be $1,600. And of course, we talked about the other levels there as well. Okay, so that's the risk on this position, and it's a 4-to-1 risk-reward ratio. Okay, Daryl says, if assigned early, what is the solution for not being assigned? Well, this is something we discussed in one of our recent presentations. I'll show you everyone where that archive is. In most cases, if I open this bull put credit spread, I have a stop in place, or a mental stop, or I'm going to look to manage the spread. If I sold the 122 put, that's sort of my pivot point. The short option is really the one I'm focused on here. But I'm going to look to close this position if the stock reaches within 1 or 1.5% of my short put strike price. So over the next 14 trading days, if the stock ends up trading at around 123.20 or 123.40, for example, somewhere along those lines, it pulls back here and it drops down about 123 or maybe even 123 even, I'm going to consider buying to close this short put and or making an adjustment to where I might lower the whole spread. I might convert this into a debit spread by doing a pendulum adjustment here. I may just close my bull put spread for a loss and open a bear call spread now that the stock's going against me. You could lower the bull put down to different strikes as well. There's other management techniques that you can use. But in general, when you open this position, you're going to look to manage the position before the stock goes below the short put. And if it gaps down and it goes below the short put, can you avoid early assignment? Well, you could buy to close your put now, but you're going to be in the loss zone, of course, most likely. But that's okay because you're trying to avoid further losses in that case. If you leave it open and the put's in the money, you can be assigned at any time. Just remember, it doesn't always happen that often, but it depends on the situation for the stock. Rhonda asks, would you say a bear put spread is less risky in a worst case scenario because a short put is in a lower price than the long put? The bear put debit spread. No, Rhonda, actually it's not. There's the vertical spreads all have parity trades to one another. Okay, let me show that in just a second. Okay, Bill asks, would you be safer than not to take the $2 spread? Some investors prefer only to take a 5-point spread, all right, for other management techniques. The 1-point spread would give you a lower risk, Bill, but then you're receiving a lower net credit. This is a question I cannot answer for you directly. What is the best spread to take? That really comes down to your personal account size, how much you're looking to put in each position, the minimum net credit, and the minimum premium you're looking for in your portfolio per month. It's not just about the return. You know, here we have a 25% return in our 1-point strike difference. We had a 26% return. It's not just about return. It's about what makes sense monetarily. If you're only in a really small account and you're only trading 2 or 3 contracts and you say, oh, I've got a 26% return with that $1 spread for a 21-cent premium, well, you're correct. But if you're only doing 2 options, 2 contracts because of a lower, and you're only allocating maybe $100 or $200 to this spread, and you're only collecting $80 or so minus your commissions, which might be as high as $15 or $20. Okay, so you're taking $60. Sure, you're taking in $60 for what you're risking of about $80 in this case. Remember that 26% return, I'm sorry, it would have been around, it was 20 to 80, right? So it would have been about 160 here for the 2 contracts or the 4 contracts. But it's $80. Well, how big is your total portfolio? Does that $80 really help your return in your portfolio, or does it work out to be just 0.5% or 0.2%? Okay, so this is a question that you sort of have to answer for yourself based on your account size, your risk threshold, your monetary risk threshold as well, and what works best for you based on that level as well. Okay, let me show you another example here. Okay, sorry, I had a couple questions. Daryl came in and says, how reliable are the probability figures in the option chain prices of the tables? About as reliable as you'll see in anywhere else because most option services, in fact nearly all option services, use the same probability equation. It's based on the past 52-week trading range of the stock, which allows us to apply a standard deviation, one standard deviation, that value. Using that, we can apply a bell curve and see based on where the stock has been. What is the likelihood that it be at or above a certain strike price at expiration? Okay, and in normal market conditions, you know, I don't want to sound silly just throwing out statistics. One of our other employees here, Mike Phillips, who used to run the PowerOptions Applied Service, he ran about a year's worth of data, and he found the probability was about, 65% reliable. And what he means by that is that 65% of the time, the probability is right to within a tune of plus or minus 5% for certain positions. But the reason why it's so skewed, why it's not higher, even with looking at deep out of the money and deep in the money positions, I think you threw all those out and just kind of focused on sort of the relative ones between, like a 90% probability to a 10% probability. But the equation is always going to be flawed, because during that 2 to 3 year cycle, he sort of looked at this historically. What ends up happening is that you cross earnings. So anytime you cross earnings, you can throw it out the window. A good example that we saw during last Wednesday's webinar, the PowerOptions Portfolio Tools, we were talking about a stock called Aruba Networks, which I almost opened as a married put back on February 18th. The stock was around 1857. I was looking to open the 20 strike put for a risk of about 6%. Earnings were coming up on around February 25th or 26th. The stock gapped up from $18 to $24. Okay, so at the time, if you looked at the chain when I opened that position, the out-of-the-money 20-strike call in the stock at 1857, the 20-strike put, had a probability above, theoretical probability the stock would be trading above that at March expiration of about 30% or less, I think, maybe 28% or so. Well, you have earnings, so now it's gone from a 30% or 28% probability when the stock was at 1857 to now it's close to around an 81% probability that it's going to be in the money, that the stock's going to stay above 20 because of that sudden gap. So with certain events, unexpected events too, such as black swan events across the market, even market corrections, the probability is a little bit strenuous at best because the probability calculations are based on sort of, log normal market conditions as well. Saying that if things continue on as they have, then yeah, you could expect this probability and it'll be right most of the time. But anything can happen inside the market. Another example of this is back in November or a little bit leading up to Thanksgiving. you could look at multiple oil stocks and you'd see the just out of the money call maybe had a 45% probability. The just in the money call probably had a 65 or 70% probability the stock would remain above it. Then OPEC came out and released their news that they weren't going to increase the production, for example, or that they were going to leave the production as was, and it started to just affect the oil prices. The oil prices started to drop. And likewise, most of even the bigger oil companies started to fall as well. So those probabilities were kind of thrown out the window because it was an outside impetus. And Steve brings up a point that we have to address as well. Steve mentions that the probability you're seeing on power options is the probability at expiration. Okay, it's a one-shot kind of view. The theoretical probability in our case for March 20th, what is the theoretical probability 14 days from now that the stock would remain above 122? Based on the way that Apple has been trading, you've got a probability of 74.4%. Another equation that's sometimes used is known across the markets is called the Monte Carlo or the ever probability. And the ever probability says what is the probability that the stock at any time between now and expiration will hit this strike price. And Steve says it's probably higher. Isn't the ever probability kind of higher? In most cases it is. Some cases it's not, but in most cases it is. So the ever probability here might be as high as 79 or 81% or so. That at any time during a trading day the stock might come down and touch 122 or go a little bit below it, and it could go back above it afterwards. Regardless, the key here, well not regardless, but that's just the probability discussion. When we look to open a new position, we want to look for a good probability that the position will expire worthless. I could find a much better risk-reward ratio here. I could sell right now, do a bull put by selling the 128 and buying the 126. I might have a reverse risk-reward ratio where I have a potential return that's higher than what I'm risking on the 2-point spread or the 1-point spread because it's an in-the-money put. My probability of that being successful and earning that return is only 20%. Okay, so I have a very small probability that I'll be successful even though I have a higher risk-reward ratio. And I'm sorry, it wouldn't be higher than the total net credit. You still have a different risk-reward ratio. Let's just take a look at that real quick. What would that look like? Let's go to March 20th, and I want the 128 put and buy the 126. We're going to collect about 365. We're going to pay about 260 on a 2-point spread. Okay, so we're going to sell one at 365. Okay, we're going to buy the 126 put at 262. So now we're taking in, this one is sort of a little bit higher than 1-to-1. We're taking in a premium of 103, and we've got a max risk of 97, so we've reversed that risk-reward ratio in our favor. But now we have a lower probability. In order to get that 103, stock has to be trading up above 128. All right, so we need a 2-point movement in the next 14 days and needs to hold that so that both puts will expire worthless. Is it possible? Yes. You're going to have long-term success looking for positions, bull put spreads that have a 1-to-1 risk-reward ratio with only about a 20 to 30% probability of success. No, you've got to be expecting to be wrong 70% of the time and just hoping that the 30% of the time that you're right, that you'll make more than you lose. But when you're close to 1-to-1 like you are here, you're not going to make money that way. You need to be right more than 50% in order to see the gains. There's no guarantee you do that with this sort of risk-reward ratio. Okay, now, another tool that I use, that we advocate using for analyzing spreads one stock at a time is called the spread chain. And we're just going to use Apple again. But I'm going to tell the system now that I want to see 2-point spreads for our bull puts. Let's go to put credit and call debit parity. So I want to use 2-point spreads. I want a minimum net credit of at least 10 cents. I want to be 1% out of the money or more. Minimum return 2 is good, but we're going to force that probability to be at least, well, we saw it at 74.4, so let's force it to be at least 74%. And I'm just going to look at standard March 20th expiration. Okay, so now we're seeing more positions here. We're actually able to get that 10-cent net credit, and we still have that least. Oh, I'm sorry. Let me try that again. Let's go to 75% probability. There we go. Okay, much better. All right. So now we see these different positions. Of course, we're not seeing the 122. Let's lower that down to 70. I'm sorry, folks. Let's go back to that 74% probability. There we go. So now here's the spreads, if we were interested in 2-point spreads that match the other criteria we wanted. Minimum net credit, 74% probability. So here's our 122, 120, and we see here we're getting a little bit better net credit using the midpoint, right? We're looking at 40 cents versus 42, and there's our 26.6% yield. Now the reason why I like this tool is if you wanted to go for a higher probability, let's say you wanted the 121, 119, your bull put credit spread, where we'd sell the 121 put and buy the 119, would generate 34 cents of net credit using the midpoint, still a 20.5% return, and we've got almost an 80% probability that Apple would stay above 121 in the next 14 days, and we'd realize that full profit. But what's important to note, what I'm looking at here is what's called the put credit and call debit parity. Okay, and so what this means is that the bull put credit spread, a parity trade to that is the bull call debit spread. So if I bought the I sold the 121 call and bought the 119 call, well, I'd have to pay a debit. It would cost me $8.22 to buy that 119 call, and I get $6.57, so I'd have a debit of $1.65. But in this case, it has the same risk-reward profile. If the stock stays above 121, my calls remain in the money. So I can close out the call spread, we get the $2 back, so I'd have a profit of 35 cents or a 21.2% yield, and of course the probability is the exact same. It's just the probability the stock would be above 121, which is the same for the bull call and for the bull put. But in this case, it's a slightly higher return. It's only 1 cent, right? The 165, we get $2 back, we make 35 cents versus 34 cents. But the reason why we like this view is because it's always important to check the parity view to see if you can get a little bit more bang for your buck. Here's another one where it's 21 cents on this spread, or 11.7% on our bull put. We have a 12.4%, or roughly 22 cents here on the bull call debit spread. A reason I bring this up is because Rhonda asks, would a bear spread be less risky in a worst case scenario since the short put is a lower price than the long put? Well, no. A vertical spread by definition, when you're looking for the probability of success that most investors do, 75 or 80%, you're still looking at a 5-to-1, 10-to-1 risk-reward ratio. Let's go over to the call credit and put debit parity. Put in our same views here. Oh, 10 cents, not $10. Okay, 75% probability. Let's next that down to 74. Okay, and let's go ahead and submit that. So in this case, Rhonda, instead of doing a bull put credit spread, where we were here, remember this profit and loss chart, we were selling a 122 in our example, buying a 120. We were looking at 40-cent credit on the bull put divided by the 160 risk, and we had a 74% probability. Okay, well here's one where a bear put debit spread, if I sold the 132 put, which is in the money, and bought the 134 put, okay, so a bear put debit, the debit would cost me 162. If the stock stayed below 132 at expiration, we could buy shares of stock at 132, force someone to buy our shares of stock at 134. We'd get $2 back, so we'd have a return of 38 cents, maximum profit here, divided by the 162 debit we paid into the position, which would be a 23.5% yield with a 77% probability. Okay, so the stock's at 126.60. The 122 is $4.60 out of the money, and we see our roughly 25% yield here, the 40 cents to 60. The 132 is going the other direction. We're about $5.40 in the money and have a 77% probability. We're risking 162 to make 38, so the risk rewards are almost exactly the same when you look for the right probability. Just as we saw with the bull put credit, could I get a higher return by doing a closer strike? Sure. You could sell the 128 put and you could buy the 130 put on Apple, but you'd have a much higher return, but now you're back in that 50 or 60% probability range as well. Okay. Now, that being said, are there different ways to manage this position? Sure, if the bull put goes against me and the stock starts to fall, well, I can buy to close this short put and leave the long open, and if it continues to fall, I might be able to make that back. However, on the debit spread, it's a little bit tougher. If the stock starts to go against me on my bearish spread and starts to go above 132, my 134 put is not going to continue to gain money. It's going to continue to lose. So the debit spread does offer one less way to manage the positions, in my opinion, than the credit spread as well. So Rhonda, the credit spreads by definition, when you're looking for a good return or a good probability of 70% or higher, you're going to be in that 5-to-1, 10-to-1 risk-reward ratio, regardless if you're doing a bull put credit spread, a bull call debit spread, a bear put debit spread, or a bear call credit spread, or combining the two credit spreads, creating an iron condor. Okay, and Daryl says, aren't these 10-cent credit type trades awfully low in payoff? What's the minimum estimated credit that makes a trade viable? Again, that's the question you have to answer for yourself. I put in 10 cents, Daryl, just as a minimum, looking for the 74% probability. But look here, even the stock that's offering, even the spread position here for our bearish spreads, our bear call or bull put with a 137, 139, the one with the 92% probability is the only one that offers a 10-cent credit. Here's ones with 29, here's one with 36. But you see, here for Apple, for 14 days out in time, there are no bear call spreads using the midpoint, and we didn't really see any bull put spreads that had higher than a 74% probability and offered us more than 40 or 50 cent net credit. Okay? So if you want a higher payoff, Daryl, you've got to take a lower probability. You've got to go closer to at the money. Okay, let's go back to the bull puts where we started. Well, let's just go back to the main credit spreads for now. Since, Daryl, it seems like you're focused on the credit spreads. There's nothing wrong with that. But instead of talking about credits versus debit, let's focus on credit spreads. Here's a view that's going to show us the bear call credits and the bull put credits here. We're going to keep our spread width at 2 just for right now on the spread chain. We put a minimum net credit at 10. Yeah, let's leave that probability of 70. Okay, so on the right here, Daryl, these are our bull puts, right? We start off with that 122, 120 spread. This is the first one that offers at least a 74% probability, and the max premium is 42 cents. Is there a higher spread with the 124, 122 bull put, or the 123, 121? Yes, but it doesn't have higher than a 70% probability. Otherwise, we would have seen it here in this list. Looking at the bear calls, right? So where I sell a call that's out of the money, stock's at 126, we sell a call that's out of the money, and we buy a higher strike call to create the credit spread. The first spread that offers us a 70% probability here, minimum, is the 133, 131. I'd sell a 131 call, buy a 133, and yeah, I make 45 cents or a 29% yield for a 2-point strike difference. We have a 72% probability. But again, as you go deeper out of the money for the higher probability, the trade-off is you have to give up net credit. How can I get a higher net credit but keep the same probability? I've got to increase my strike prices. So let's force the system now, instead of doing 2-point spreads, let's look for any spreads on Apple that have at least a 5-point strike difference. I can up this to 50 cents if you want to. Still 1% out of the money, still minimum return, and still a 70% probability. Let me lower that return down, actually. Let's see what we get. Okay, so now we've got the 131, 136. Now, you're receiving an 85-cent net credit. So if you did a bear call credit spread by selling the 131 call, remember our stock's at 126 here, so we sell a 131 call, it's about 5 points out of the money, 450 out of the money, and we're buying a 133. Here, we receive that 85 cents net credit. Okay? But our return is still 20.5%. Why is that? Because now our margin requirement to enter this trade is $4.15. So instead of putting up $1.60 per contract, or $320 for 2 contracts, or $1,600 for 10 contracts, I'd put up $415 for 1 contract, $830 for 2 contracts, or $4,150 to enter 10 contracts. Now, if I'd make $850 against $4,150, but that's a 20.5% return, and we're still at the same probability. This is kind of the game. What are you looking at? To maximize net credit by using a wider strike difference, which is going to increase your margin requirement and keeping the same probability, of course. And your return, is going to be reflective of that as well. Or is your goal to maximize the value you have in your account? So again, if I was looking, if we had $1,600 to invest on this bear call spread, we wouldn't be able to do 4 contracts. That'd be just above $1,600. So we'd have to do 3 contracts, which would be a margin requirement. So we do 3 of these. It'd be a margin requirement of $12.45, right? $4.15 times 3. So that's what we'd have to have on hold in our account, $1,245 in our account to place the trade. And we're going to make $225 against this 1245, which is a 20.5% return. Okay, so let me jot that down over the side here. No, the chicken scratch is doing real well for everyone. But we have 225. It's an 85-cent net credit on a 5-point spread times 3. So we take in 225, and we put up $1,245 margin. Now I go back, and let's change this back to 2. And remember, that's the 72% probability. Don't even see it there. You know why? Because none of those 2-point spreads offer a 50-cent net credit. So here's the same position. It's using the 131, but now instead of using the 136 call for that higher credit, because it's a lower cost, I'm using the 133, which cost me about 78 cents. So here, on the 2-point spread, I'm only taking in, 45 cents, 0.45, and my risk is margin requirement 2 minus the 45 would be 155. And again, I've got $1,600 to invest in this position. Okay, so that would probably dictate that I can do 9 contracts. I can almost do 10. Oh, I'm sorry, we can do 10. Okay, so we would do 10, and that would be $1,550 margin requirement. And then my total net credit now would be $450. Okay, so that's interesting, isn't it? Here, with a 45-cent net credit on the call spread, on a 2-point spread, if we had $1,600 to allocate, we could do 10 contracts, which would still risk $1,550 as opposed to the $1,245 of the other spread we saw. But our monetary gain, what we take in monetarily into our portfolio, would be $450 on this 2-point spread for 10 contracts. Whereas our 5-point spread, we could only afford to do 3 contracts, and that was $225 monetarily against $1,245. That's a 29% yield versus the 20.5% yield on the 5-point spread. So is the upfront higher net credit necessarily something you want to look for, where we could get 85 cents, almost double this with the 5-point spread? Well, no, because we more than doubled the margin requirement, so it didn't work out mathematically. This would actually be a better spread if you're doing 5 or 10 contracts, depending how much you're willing to risk in that investment as well. Oh, I'm sorry, Daryl. I think you're misunderstanding 2 things I'm saying. Daryl says if margin estimates are used, it seems like a bogus calculation versus what the actual risk can be. No. When I say margin, what I'm talking about is what your broker would require for you to have on hold in your account. I'm not talking about margin as a percentage. Vertical spread traders, when they refer to margin, they're referring to this true risk. Okay, the true risk for this bull put, this bear call we're looking at right now, Daryl, let's open this up a little bit here, is the difference in strike prices minus net credit. That's the most I could lose on this position. Okay, and in this case, if I'm taking in 45 cents, that means a max risk is 155. We have a 2-point spread. We take in 45 cents of net credit, which we keep no matter what. So if the stock is anywhere above 133 at expiration, we buy shares of stock at 133. That's the obligation of the call that we bought. We sell shares of stock at 131. That's the obligation of the call that we sold. We lose $2. We keep the 45 cents. We lose $1.55. With 1 contract, that's $155. With 10 contracts, that's $1,550. Now, when I say margin requirement, Daryl, I'm not talking about a fourth of this value. Okay, I'm not talking about 155 divided by 4 or 1550 divided by 4 if you're allowed to use 25 or 20% margin. This number is the margin. Okay, it can be confusing, but that's the term that brokerages use. So if I open this bear call credit spread right now today at my account at Options Express and I did 10 contracts, I'd have to have on hold in my account $1,550, which is referred to as the margin for this leverage spread trade. It's not 1/3 of that. It's not 1/2 of that. It is the actual worst case scenario. The maximum risk here is $1.55. For 1 contract, it's $155. For 10 contracts, it's $1,550. Okay, and that's what we mean by the margin. That is the worst case scenario. That is the max loss. I'm not taking a third of this. I'm not borrowing money to enter this trade. It's like a naked put. I'm putting up the total cash secured amount of the 2-point spread difference minus my net credit. I know that can be confusing when you're looking at your broker and they mention about margin and you have 25% margin or 50% margin. When we talk about a vertical spread, the money we'd have to have on hold in our account to place this trade is equal to the difference in the strike prices minus the net credit. Okay, that's the most you can lose on the position in the absolute worst case scenario. This stock could go to $1,000 per share. I'm not going to lose more than the $1.55. On the bull puts, the stock could drop to $1 per share. I'm not going to lose more than that $1.55. But it's the difference in the strike prices minus the net credit times your number of contracts times 100. It is leveraged itself. Okay, so they don't let me, most brokers won't let you use margin on this, a third of this or a fourth of this or a half of this. There's some will based on your structure, but you really don't want to do that. If I'm using leverage to open a credit spread, for example, then the leverage is good enough for me. Okay, I'm putting up $1,500 to make, what did I say in this case, $450. That's all the leverage I need in my account. I don't need to take a third of that $1,550 to enter the leverage spread trade. Okay, so I do apologize for the confusion. I know that can be confusing sometimes when you're looking at these spread trades, but margin doesn't mean a percentage. When we say margin, talking about a vertical spread, we're talking about the true max risk, the most you can lose if the stock goes against you in that given position. Okay, and yeah, Rhonda made a point that the parity trade is really good, really useful. It really is. If you're doing credit spreads and you've decided that you're bullish, it's always a good idea to use this put credit and call debit parity. So you can see the bull put credit spread, and then you can evaluate the call debit to see which one gives you the best bang for the buck. The only thing that you have to remember in this scenario is that if I enter a bull put here, you know, one of these bull puts, if the stock does what I want, both options expire worthless, I keep the net credit, now I don't have to do anything else. My broker may charge me a small transaction fee for an expiration, but he may not. The broker may not. On the debit spread, if I sell the call and I buy the call and the stock moves up as I expected, I have to pay the commissions for another transaction because I'm essentially buying stock and then selling stock. They're not expiring worthless. I'm doing another transaction, or selling to close my long call and buying to close my short call to get the $2 back for the max profit. So this will incur extra commissions. But if I'm looking at 5-point spreads, a lot of time in these 2-point spreads you won't see it. You might see a difference of 2 cents or 3 cents or $2 or $3 total for one contract, what do you mean by 2 or 3 cents. And with extra commissions, depending on how many contracts you're trading, might not be worth it for you. And so in that case as well, what we're looking at here is, I'm sorry, we take in the extra commission. So for a 1 or 2 cent increase in profit here from a debit spread to a credit spread might not be worth it monetarily for you, depending on what your commissions are to close the debit spread. But on some of those 5-point spreads, you might see a difference of as much as 20 cents or 30 cents. And if I'm trading 10 contracts, that might be $200 or $300. You know, that's more than worth it to do that, to take on the debit spread, which has the same risk-reward profile, just will charge me an extra commission as well. Paul mentions, but once you receive the net credit, so let's talk about our 20-cent, where were we? I'm sorry, 42-cent net credit on our 2-point spread here again. Let me write it up here so we can all see it. So I'm taking in 42 cents to risk 2. Really, we know that means our true monetary risk here on the 2-point spread is going to be $1.58. Okay, that's our margin requirement. Times 10 contracts would be $1,580. Well, Paul says, but once you receive the credit, you can still lose the full 2 points. Right. If this closed out for a loss in my bull put credit spread here, Paul, sure, I would see a loss of $2 from the obligation of buying shares of stock at $122 and then selling them at $120. That would be a full loss of $2, the full $2. But I still negated it by the $42 I took into my account. Okay. Now, I don't do this, but I know some investors do. When I go to enter credit spreads in part of my portfolio, about 10 to 15% of my portfolio at any given time are devoted to credit spreads, bullish or bearish, on the broad-based ETFs or indexes. Okay, so I might enter 2 or 3 spreads on SPY, IWM, for example, or QQQ because they offer dollar strike differences instead of trying to take a 10-point spread on the index. Right? I want to use money more to my advantage by using the 2-point strike differences or maybe 4-point strike differences and so on instead of having to use a 10-point strike difference. In any case, when I allocate the funds that I'm going to use in my portfolio, that 10% or so that I'm going to allocate to the 2 or 3 spreads I'm using. That's all I'm going to do. What I'm not going to do, Paul, is, okay, I did an SPY trade and I took in 40 cents on a 5-point spread, so I took in $200. I'm not going to reallocate this, I'm sorry, that's bad nomenclature. I'm not going to allocate that $200 back into the margin requirement to use to open another 2-point spread on another position. I'm actually just going to take that into my account and use it as premium. I've already allocated what I can use for the 3 spreads or the 2 or 3 spreads I'm opening in that time frame with the 10% of my portfolio I'm allocating. I do understand what you're saying, and you're absolutely right. If I just take into account that we took in the 40-cent net credit, we put it into our total cash on hand in our portfolio, and we view that now as money we can use to open new trades or to manage existing trades, yep, I could still lose 2 points on this. But in reality, to my portfolio as a whole, from the transaction when I opened this to when I closed it for the full loss, I would have only, if that was the only position I did, my portfolio would only be down the $158 or the $1,580. My portfolio value wouldn't be down $2,000 because I still kept that premium in my portfolio as well. Okay. So, and as far as the taxes go and accounting goes for your broker and your tax man might want to see that as a $2,000 loss and $158. I'm sorry, a $2,000 loss for 10 contracts and a $420 in, but everyone has their own different way of viewing it as well. All right. Well, ladies and gentlemen, we're at the 5:26 mark. It's 5:26 p.m. Eastern Time. If anyone has any last-minute questions, I encourage you to go ahead and send those in. For those of you, Bill, earlier you would ask questions about this, and Daryl, you would ask some questions as well. If you go into your PowerOptions account, whether you're free trial or your subscriber, underneath the main home tab, go to free webinars. If you haven't done so already, we have the PowerOptions tools archives available, the different tools in PowerOptions, options concepts, things such as implied volatility, the Greeks, insuring your stock or a portfolio as a whole with different options. But in the options strategy section, we recently did 2 presentations on what is the vertical spread and managing your spread positions. And Bill, in addition to today's conversation on spreads, which I'm probably going to add into this field here, usually we put the open discussion recorded webinars in the options concepts, but on Monday I'm probably going to lump it into the options strategies and include it here with the vertical spread, and we're going to call it analyzing risk and analyzing spreads on PowerOptions. We'll include that with this little 3 block here. But yeah, when we talk about what is the vertical spread, it's a basic introduction. Managing your spread positions, here's where we talked about what we look to do to manage that bull put or that bear call spread. Once we open it, what are trigger points for maybe looking to roll the position? And here we talk about what are the 5 ways that we tend to use to manage a bull put or a bear call. Not all 5 at once, but depending on the situation, there's 5 different possibilities. We discuss the pros and the cons of the 5 different management techniques that we advocate as well. Daryl says, if doing iron condors, don't single strikes give a better return? Daryl, this is the same conversation that we just had. An iron condor is nothing more than the combination of a, let me go back one actually. Let me go back a few pages here. Let's see if we, come on, do it. There we go. Let me go back one more. So can I get some of my results here? Sorry, folks. Haha, not what I wanted, but I'm going to go here anyway. Okay. Daryl, the iron condor is nothing more, and this is sort of drawn backwards for what I'd like to see it, but the iron condor is nothing more than a combination of your bull put credit spread with a bear call credit spread where both are out of the money. This tool is the same thing you can use to identify an iron condor. It's just not set up the same way. What I mean by that is that if my iron condor requirements are, I want to enter a bull put and a bear call, 4-leg position, bear call on the upper side, bull put on the lower side, I want both spreads to have a 75% minimum probability and both spreads to generate at least a 30-cent net credit. Well, there's my one iron condor that matches my criteria for Apple for March 20th. Okay? And what I mean by that is that here, with our stock at 126.60, our bull put that matched that minimum criteria would be the 121.119. Here is our bull put credit spread. And then our bear call credit spread would be our 132.134. Okay, so there we go. There's our iron condor. Now, is this a better return because of single strike or smaller strike differences? Yes, but I'm taking in 36 cents and I'm taking in 34 cents. Same discussion we just had with the credit spreads. Is it better to take 85 cents on a 5-point spread, which might work out to $1.70 if you can get 85 cents for both on a 5-point spread with an iron condor, maybe using the 132, 137 and the 121, 116. All right, so you might get $1.70 for both 85 spreads here. You know, you go bigger loss, and to actually higher monetary return, bigger loss. Okay, all right. So for the 5-point spread, we might take in $1.70, or a 2-point spread, you're taking in, let's call it 35 cents. So for our 2-point spread, we're taking in 70. Okay, 70 cents total on a 2-point spread on the lower end or the higher end, or $1.70 for a 5-point spread. Which one gives a better return? Well, it's going to be this one, isn't it? And so you're right. And that's exactly what we just saw with the vertical spreads itself. That percentage return with the same probability, 72% on that one bear call we were looking at with the 2-point spread for Apple, that offered a 29% yield. The 5-point spread, using the same strike on the bear call, only offered a 20.5% yield. We were taking in 85 cents on a 5-point spread versus 36, or actually it was higher than that, it was 40 cents on the 2-point spread, okay? So it's the same discussion we had. Is every stock going to be that way? No. That's why you want to use these tools to evaluate it if you're trying to compare single strike versus 2-strike versus 5-strike. Use the Parity Trade tool here, the spread midpoint spread chain, and look at not only the Parity Trade view, but just the credit spread view to see, are your 5-point spreads a better return total versus your 2-point spreads and so forth. Again, what did we come down to? More money directly, more monetary value directly, higher monetary risk, lower return, the same probability, or smaller net credit, which works out to a higher percentage return. What are you more concerned about in your account, Daryl? That's a question you have to answer for yourself. Are you more concerned with the percentage return on your spread, or are you more concerned with the monetary value? Okay, that's what we're looking at. All right, Doug says, sorry I was late. It's glad to see this being recorded. Very interested in straddles and strangles. Unfortunately, Daryl, I'm not Daryl, sorry guys, Doug, I don't think I'm going to get a chance to get into straddles discussions today because it is at 5:32 p.m. Eastern Time. However, that being said, I wanted to go back real quick. We do have, as you saw just a moment ago, Doug, the free webinar section, and anyone can access this at any time. You don't have to be on a trial, and you don't have to be on a subscriber to PowerOptions. You can just go to powerup.com/webinars.asp, and that'll take you to this public page, and then you can click on which sections you want for the options concepts, requested concepts as well. Doug, if you're currently on a trial, when you go into the other strategies tab here, and of course you're not on a trial, you can just go to powerup.com, put in your first name, last name, and email address, and you can register for a 14-day free trial. But when you go into your page, and when you start your trial, go into other strategies, you can take out 1 or 2 of the strategies you're not interested in. We could, of course, add long straddle and add long strangle. And, of course, save the configuration. And the reason why I want to go here is, in addition to the tools that we have where you can search for long straddles or strangles that match sort of your cost basis and risk profile, that search by symbol tool we looked at for bull puts earlier in the presentation, you also have available here for the long straddle and long strangle. But let me just click on this. There's a quick article here that Ernie wrote. It's a public article, I believe. I'm going to send this link to everyone, and it's his thoughts on sort of using the long straddle and long strangle as we get closer to earnings. What we feel is a good way to view using a straddle at earnings. Many investors try to go the shortest time frame. So if I have earnings coming up in 2 weeks, I'm buying the long call and the long put that are 2 weeks out or 3 weeks out. And Ernie's found that, doing some historical testing, that the options that are further out in time will actually work better, due, of course, to many reasons as well. In addition to that, those of you interested in long options, if you go to the long call or the long put, there's an article here that Ernie wrote for using the Bollinger Band analysis for buying calls or buying put options as well, so you might want to check that out also. All right. Well, ladies and gentlemen, I think that about is going to wrap us up for this afternoon. If you do have any last-minute questions, go ahead and send those in. We'll see if we can address those today. I just want to remind everyone, if course, if you haven't yet, go ahead and register for that 14-day free trial. Just go to PowerOpt.com, and you can quickly just put in your first name, last name, and email address, and then start your trial. We'll send you a password, and you can get started. After the trial, our 20-minute delayed service is $60 per month. And then, of course, we do offer a 20-minute delayed and historical where you can access our backtesting tools where the data goes back to April 2006, and that's a total of $100 per month, so just $40 more to get the historical tools. Right now, we are also offering an end-of-day data service, which is only $40 per month. We also offer the real-time service. So those of you doing spreads, you probably want the real-time to see the calculations done in that instant. And the real-time is $100 per month. Of course, you can move up to the historical and the real-time at $140 per month as well. Coming up next week, I do believe that Kurt told me that next Tuesday he is not doing a radioactive trading presentation. We did the Power Options portfolio tools this week, actually, last Wednesday, and we did record that. That's in the Power Options tools archive. So we're going to do a strategy discussion on Wednesday. I'm just not sure what it is yet. We'll let you know. And of course, next Friday we'll be back with the open discussion, open forum presentation as well, similar to what we did through today's presentation. All right, well, if you think of any questions later on, just go ahead and send us an email to support@powerop.com. Doug has said, I heard you want to avoid the high volatility and high volume rate before earnings. Yeah, that's it. I mean, that's one of the reasons why, you know, that article discusses there that we're looking to go further out in time. The reason why is that, well, everyone's projecting that earnings are going to have an effect on the stock one direction or the other. So the implied volatility is going to be drastically increased when you're looking to get into those positions. You might buy a 5-point spread. Again, let's take Apple at 126. It's not that volatile right now, but coming into earnings a few weeks before earnings, you might see that the 5-strike out-of-the-money call, the 131, and the 121 put are both about $5. So you paid $10 to get into that spread. Well, that means in order to profit on the position, the stock's going to need to drop down to 111 or go up to 141. And that's just too much to expect. I mean, that's a large gap. Is it possible that Apple could gap that high due to earnings? Yes, it's possible. But it's not realistic, okay? So sometimes it's better to go further out in time where the volatility doesn't affect it as much. Plus, you can always have that event where the earnings come out and the stock only moves plus or minus 1%. Doesn't really show you the gain that you want. And in that case, then, if you've got a shorter expiration, you've essentially taken 100% loss in the position as well, okay? Daryl's, I'm sorry, so yeah, that's why we want to go further out, and we also want to give the stock more time to move in our direction, and in some cases, you've seen a max or near max loss or no change for the first earnings, but if you bought your calls and puts out far enough and didn't overpay for them too much, you actually have enough time to cross through another earnings where you might see an event. And Daryl says, what source do you suggest for using to determine ex-dividends and earnings date? I use PowerOptions, but I verify it just to make sure at other times. What I mean by that is on PowerOptions at any time, if I'm in any search, let's just go to covered call. I don't have it selected yet, but if I'm in any search, oh, there it is, I can select to view through that choose columns button the earnings date, the ex-dividend date, the dividend yield, and when I'm on my search in any strategy, I can choose to avoid stocks that have an earnings date between now and expiration. I can choose to screen specifically for stocks that have an earnings between now and 2 weeks from now, or between now and expiration, and the same with the ex-dividend date in most strategies as well. As I'm researching a stock, let's say I'm looking at this covered call in Ambarella, I can use the More Information button and go to Stock Research, and I would have selected, if it was something important to me, I would have had that selected as one of my columns in my search, or the search by symbol, for example, but usually the search. But if I don't have it selected, hey, one click away, my next earnings, it's not really confirmed. I'd look at maybe my Fidelity source or my other broker perhaps to try to verify if anyone has a confirmed date. Most likely no one does yet for the 6/2 earnings, but we know it's going to be around that time frame. And there's, of course, no dividend, so I don't have a next ex-dividend date as well. But we'd see the next ex-dividend date here on PowerOptions if the stock paid a dividend. So you can have that added to your search columns, the earnings date, the ex-dividend date, and so forth. Or you can, of course, just look at it very quickly with one click away from that quotes page. Doesn't hurt to verify it, though, with other sources as well. All right. Well, ladies and gentlemen, thank you again for joining me this afternoon. I hope you all have a fantastic weekend. Again, if you think of something later on, send me an email to support@powerop.com or give us a call during market hours. You can reach us at 302-992-7971 at any time. Thank you again, ladies and gentlemen. Take care. We'll see you soon. Good night.